Hi, good morning, everyone. We are going to start the webinar now. This is Richard speaking. So for today's webinar, we'll have a results update for ComfortDelGro and SETS, and then followed by the sector update for the industrial REITs. So this is our usual disclaimer. Please read it. Okay, so first is ComfortDelGro. So ComfortDelGro announced its full year results last Friday evening. The revenue at PATNI was in line with consensus expectations, and we have upgraded it to accumulate rating with a higher target price of $3.21. Last close on Friday was $2.79. So this table is a summary of results. Top half shows the revenue performance for their various business segments. This is the revenue for the group. So going here, the key business for ComfortDelGro still remains the bus and taxi, and then rail is expanding as well. So for bus, revenue year on year for the full year was higher by 3.1%. This was due to increase in Singapore, but offset by weaker Australian dollar for their Australia business. So in Singapore their bus exposure is mainly through SBS Transit, where they own 75% of SBS Transit, and so there was higher ridership and higher average fare. For taxi, revenue was higher as well. This came from higher revenue in Singapore and China, and this was boosted by the favorable RMB translation, but offset by weaker Australia dollar. Rail, there was higher ridership and higher average fare. ComfortDelGro's exposure to rail is through SBS Transit as well, and they operate Downtown Line and Northeast Line. So going at the group level, revenue was up 1.5%. The actual revenue increase was 83.2%, and this was partially eroded by currency effect of Australian dollar. The effect was 23 million. The EBIT was up 1.9%, and now their EBIT is 46% comes from overseas business. Remainder is from within Singapore. PATMI was up 6.5% year on year, and it has crossed the $300 million mark for the first time. Dividend payout policy remains unchanged. The board remains committed to paying out at least 50% payout ratio. So for final dividend, they have declared 5 cents for FY15. This is higher than the 4.5 cents from previous FY14. Total dividend, which is interim dividend plus final dividend, is 9 cents for this year, which represents a 64.1% payout. Previous year's full year dividend was 8.25 cents, and it was a 62.2% payout. Just a summary of their three key business segments, starting with bus. So the update is that their negotiations are ongoing with LTA, and they are expecting a smooth transition to the new contracting model. What's being negotiated now at the moment is contract pricing and treatment of the non-BSEP buses. For their taxi business in Singapore, there was no material impact felt from third-party apps. They had high revenue from replacement of their fleet. They are replacing the Sonata to the I-40. Taxi fleet was 16,800, and the unhired rate for the year was 0.8% of the fleet, which is roughly about 100 taxis. The management has feedback that this is a comfortable number as they require some spare taxis for replacements when other taxis are being serviced for their scheduled service, or whether there's been an accident and then the taxi is being sent for servicing. For rail, downtown line is only expected to break even only after the full line is open. So for FY15, the rail segment had a 3.2 million profit. This is combined with uh, and Northeast Line and Downtown Line, but for fourth quarter dragged down the full year profit. Fourth quarter had a loss of 2.2 million, and this was primarily due to some costs at Downtown Line 2. So management has guided that Downtown Line 1 and 2 are not expected to be profitable, and this is due to the startup costs which will start incurring in 2016 for the Downtown Line 3. And Downtown Line 3 is scheduled to open in June 2017. This is a historical multiples. The left chart shows the P multiple and the right chart shows the EV/EBITDA multiple. So for on the 21st of May 2014, the government had announced the plans for the contracting model for bus services, and this had re-rated the stock. So that's why you can see we have two averages where the new average starts on the 22nd of May 2014. So currently the average PE is about 21.1 times and the average EV/EBITDA is 8.2 times. From these two charts, you can see that the current multiples are close to -1 standard deviation from the new averages, and this suggests opportunity to get into the stock. Moving on to SATS. SATS also announced their full year results last Friday evening. We maintain our accumulated rating for SATS with unchanged target price of $4.05. The last close was $3.83 last Friday. This table shows their results, summary of their results. So Food Solutions saw a drop in revenue. This is the same as the previous quarter. This was due to the deconsolidation of their food distribution business that was originally under SFI, but is now being included into a joint venture with BRF. So whatever profits from the food distribution business will now appear in the JV line instead of in the top line revenue. They were also affected by the weaker Japanese yen. This is from their subsidiary TFK Corp, which operates from Haneda and Narita Airport in Japan. Gateway services was also up by 5.3% year on year, and on a whole, at the group level, revenue was down 2.2% year on year. The lower revenue was mainly due to the lower food solutions segment. I've explained the reason for the lower revenue. And then moving on to EBIT. EBIT margin expanded 2.7 percentage points to 14%. This was due to the deconsolidation of the food distribution to SATS BRF. So this EBIT margin expansion is not comparable year on year, but we think that it should carry on in the following quarters. There was also better EBIT due to better cost management and productivity gains. Associates and JVs didn't fare that well. Both types of associates and JVs, the gateway services and food solutions type, were both weaker for the quarter year-on-year, but on a 9-month basis, associates and JV is still up 1.3 million. PATMI improved 12.8% year-on-year. The improved net margin is not comparable year-on-year due to the accounting treatment of the deconsolidation of the food distribution business from the top line to the JV line. So this is an update on the 3 recent M&A announcements that SATS has made. First one is on the acquisition of the 49% equity stake in Brahim's. So Brahim's is the main caterer at KLIA, and the vision that SATS has for it is for Brahim to grow together with the newly restructured MAB. They also have ambitions to go into non-aviation catering, and so Brahim will leverage on SAT's current expertise in non-aviation catering to create value in this area as well. SATS is also expecting to derive purchasing synergies because their existing raw materials already comes from Malaysia, so they are expecting to purchase the food at better prices due to the higher volume. The next M&A is for the 50/50 joint venture with DFASS. So this joint venture will be immediately income producing, as it will ride on the existing contract that DFASS has. So DFASS sells duty free on the flights, and the intention is to leverage on SATS's existing customer touch points to increase their sales channels. Lastly, there's the announcement for their intention to create a 60/40 JV with a wholly owned subsidiary of Wilmar. This is to supply safe food in China. Their intention is to set up commissary kitchens in the south of China, one city at a time. The speed at which they expand will be dependent on level of success, and management has feedback that during their due diligence process, they've spoken to prospective clients, and the clients are supportive of them entering the market. Okay, moving on to the last part of the presentation, which is the update for the industrial REITs. So the summary, there are 5 points for the summary. Sector occupancy in the fourth quarter of last year fell as supply outpaced demand. The total stock of industrial space has increased by 1.6 million square meters to 44.5 million square meters. JTC is estimating an additional 2.9 million square meters of industrial space to come online in 2016. Our top-down view is that we are negative on the industrial REIT subsector due to the oversupply of space, but our bottom-up tactical view is that to maintain exposure on REITs with strong underlying demand drivers and the ability to ride out oversupply situation. Lastly is to avoid REITs facing significant portfolio exposure to master lease expiries. This is a summary table for the rental and occupancy for fourth quarter. You can see all the red arrows, everything was down year on year and quarter on quarter. The biggest change though is from Business Park, where there was a 4.3% year on year improvement in occupancy. This is the key takeaways that we have from the results briefing and from the results that we see in this quarter. So first thing that we hear from the REIT managers is that lower rent is better than zero rent. The managers are keen to retain tenants and they are prepared to lower their rent in order to maintain occupancy. They say that it will be difficult to sign new replacement tenants if existing tenants vacate the space. Second is not new. It was seen already in the previous quarter that some of the REITs are going conversions from master leases to multi-tenancies. If you convert a REIT property from master lease to multi-tenancy, this will result in lower portfolio occupancy, higher property expenses, and consequently a lower NPI. Some of the REITs also had their assets revalued downwards. Some of the reasons given by the valuers was challenging outlook, lower growth, and the effect of shorter land lease, 20 years and below. We currently have coverage of 3 industrial REITs. They are Capital DC REIT, Soybuild REIT, and Cash Logistics Trust. So for Capital DC, we are still maintaining our accumulate rating target price of 113. The last close on Friday was $1.50. So the theme for Capital DC REIT is the proxy to explosive growth in data requirements. So I built REIT, we also have an accumulate rating, target price 86 cents. Last close last Friday was 70.5 cents. The theme for this is that business park space will be in short supply as there are no new spaces coming on stream after 2016. Lastly, for Cash Logistics Trust, we have a reduced rating, target price of 82 cents. It had already closed below our target price last Friday. The reason why we have a reduce for Cash is that it's experiencing sluggish renewals and new leasing, and this has already impacted their portfolio valuation. This table shows the results for the 10 industrial REITs in the last quarter. Top half shows the REITs that have their financial year ending in March, while the bottom half is showing the REITs with their financial year ending in December. As you move from left to right of the table, it's actually going down their income statement, going from gross revenue to NPI to distributor income and finally DPU. So for the sector, what we saw is gross revenue was driven by inorganic growth, i.e. acquisitions. There was limited organic growth where one or two REITs had completed AIs and the building became income producing. Net property income was sensitive to conversions, so some of the REITs had their NPI was affected due to conversions of certain properties from master lease to multi-tenancies. Distributor income was broadly in line with NPI, while distribution per unit also was broadly in line with distributor income. except for situations where there was significant unit holder dilution post equity raising. This table is showing the summary for the full year results for those REITs that had announced their full year results. So it's roughly the same story as on a quarterly basis. Gross revenue driven by inorganic growth. NPI was sensitive to conversions. Distributable income and DPU were broadly in line, except for situations where there was a unit holder dilution. This table shows the performance measures for the 10 industrial REITs. One thing to note, average occupancy of 93.1% is higher than the JTC average of 90.6%. Some of the REITs disclose their weighted average lease expiry by gross rental, and some are disclosed based on NLA. So that's why you will see some blank spaces. Those are where they do not disclose by that metric. Gearing sector average is 35.5. Moving on, weighted average debt maturity, the average is 3.1 years. Weighted average cost of debt average is 3.3%, and interest coverage average is 5.3 times. This is the last slide. So this top half the table is peer relative data from market cap, price per share, price to book value, and 12-month trailing yield. The sector average price to book is now below 1. It's at 9.2, and sector average trailing yield is 8.8%. The chart at the bottom half is a graphical representation of the last two columns. Horizontal axis is showing price to book, and vertical axis is showing the yield. So what you see here is the larger market capitalized REITs generally are the bottom right corner, while the lower capitalized market capitalized REITs are the top left corner. Okay, we've come to the end of the presentation. One thing to highlight is that we have a new link for the archived webinars. I'm showing the link now, so you can go to this link to watch our archive webinar and to download the presentation slides. So now I've come to the end of the presentation. Welcome you to ask questions. Okay, there's a question from the series acquisition set seems to be moving away from the business of gateway services. How do you view this strategy? Well, actually, yes, they seem to be moving away from gateway services, but if you look at their revenue makeup, the majority of their revenue still comes from food solutions. So they're actually leveraging on their existing expertise to go into Brahim, uh, as well as the um, China catering business as well. The other one where it's with the DFSS, that one I think they will classify it under gateway services. So actually what they are doing now is they're doing horizontal integration of their existing expertise. Okay, there's a question on the target price and the key concern for sets. So obviously, one of the key concern is the state of the global economy now, and if there's lesser corporate travel, obviously that would affect sets. Likewise, if there's lesser um, leisure travel, that would affect sets negatively as well. Okay, there's a question for ComfortDelGro where saying that they've guided for flat growth for taxi revenue in FY16. Does that mean that they are not growing its taxi fleet? Well, the thing is that for growth in taxi fleet, what management has said is that they also do try to time taxi growth with COE prices as well. So uh, possibly that they may not be growing it in FY16. Also, the other thing to note is that while they are the only operator that are eligible to grow the fleet, because for taxi fleet in Singapore, you need to pass the performance standards, and then you can grow at 2% per annum, 1% per 6 months. Uh, but the thing is that they have also highlighted that in view of the competition from the taxi apps, they'll take this into account when deciding to grow the fleet. So the decision to grow the fleet comes from two factors at the moment, which they have talked about is Siri price and competition from the party apps. Okay, there's a question for REITs where and new space coming on stream dropping from 2017 and REITs focus on warehouse space. One thing for warehouse space is that although some of it is pre-committed, but this also provides a situation where shadow space might arise, and so even with the lowering new space in 2017 onwards, but you still have to contend with the excess space that has been created in 2015 and 2016, and these excess spaces also need to be absorbed as well. So it's not only just to look at less supply coming in 2017, but rather can the supply that has not been occupied, can it be absorbed as well?
Hi, good morning, guys. De Hong here. There's a question on retail REITs. We have not done a sector review on retail REITs. The last one was a few months back. But basically, what is happening on the ground, a lot of which we have already touched on during our reports, during our results reporting. So we have mentioned before that generally from FCT's results report, we have done a comparison with CMT as well. We have spoken about how generally in the last year, you see that we are facing a weak retail climate. We are seeing retail sales on the sluggish side. A lot of times you see retail numbers, year-on-year numbers on the surface, on the front-facing number, you see it like up 3 or 4%. But a lot of times, if you strip away motor vehicle sales, general retail sales is actually flat or down. And so you would think like, okay, it looks like people are buying a lot of cars, right? COE prices are coming down. People are buying cars, but it looks like, if people are buying cars, then it shouldn't be that bad, right? People shouldn't be that hard up if people are buying cars. But the truth of the matter is, if you look at the total number of cars on the roads, the total number of cars is actually not increasing, but actually dropping. So a lot of these cars purchases would actually be, I would think, for replacements, not for additional, not families buying additional cars. And then if you look at the drop in the car numbers, it's actually affecting the Cat A, the mass market cars more. So I would say generally we are facing a much tougher retail climate. If you look, if you read the news, if you listen in to the news on TV, you see a lot of this headlines suggesting as well, like Chinese New Year bazaar at Chinatown this year. The retailers are expecting, are looking at less rosy sales this year as well. So given all these developments on the retail front, we have also said during our FCT results webinar that we prefer to be invested in a more resilient REIT in FCT over CMT. Because in both, actually, you see that rental reversions have been weakening over the past few years. CMT, for instance, is seeing the weakest reversion since 2009. And then if we have spoken to management, they are seeing a lot of rental pressures going forward as well. So in this kind of backdrop, we actually advocate going defensive. FCT has the most dominant malls in the northern part of Singapore. North Point and Causeway Point, they are in areas where there's no upcoming supply in the near future. North Point is going through an AEI that's going to affect the DPU this year. But as we've written in our in our results report 2 weeks ago, we have also stated that management has already strived to maintain DPU going forward, even with this AEI on North Point. And there are several ways they can do it. If you can read the report, one of the ways would be to take lesser management fees in, or take more management fees in units, so you free up more cash. So that actually like balances out the volatility in the DPU, because when North Point AEI is completed, you can expect a good return on the investment, as previously they did an AEI on Causeway Point, and the return on investment was also like pretty decent. So as for FCT, Changi City Point is doing not too good now, but we would expect it to perform much better once the downtown line at the expo station is completed. So that is the general environment we are facing in the retail front right now. But all in all, from now versus our last report, there's not much change in what we are advocating. That is to do a bottoms up approach in times of this in these difficult times. Do a bottoms up approach and stick to the most defensive retail REIT, which is FCT. So Patrick, I hope that answers your question.
Okay, there's a question for Sunbuk REIT and Fiverr. The question is Sunbuk REIT and Fiverr Industrial Trust are trading below their book value and giving yield of more than 8%. Um, how much lower will share price go? Okay, so yeah, this is a good question. So let me go back to this chart which I showed earlier. So what I believe is that actually soybean, I said that the higher market capitalized REITs appear to be at the bottom right corner, while the smaller capitalized REITs are at the top left corner. For soybean, I think that it's been really unfairly punished to be here uh, by virtue that most of their properties are on master leases, and so they have very little renewal risk in this year. None of as well as I said, majority of the portfolio is on master lease. None of the master leases are expiring this year. The next master lease that will expire is for Solaris, and that will come in the second half of 2018. So actually, the thing, as I have shown in the presentation slide earlier, I said to avoid REITs with significant exposure to master lease expiries. So the the converse of that would be you actually do want to have a portfolio with master leases. Master leases is precisely what you want in an environment of oversupply. Okay, since there are no more further questions, we're going to end the webinar here today. Uh, Please tune in again next week